Welcome to the daily briefing from interest.co.nz. I'm David Chaston. Today we report on the collapse of yet another finance company. But first we look at the growth in credit in October, we review the changes to our money supply, and we look at the latest business confidence readings. Finally, we'll wrap up with details of that receivership and what the other media are reporting. Private sector credit growth was slightly slower in October than September and slower than a year ago, but the slowdown in growth was very modest. Housing credit grew 13.6% year on year and now stands at almost $152 billion. Although this was in fact the slowest growth rate since July 2003, it was only marginally down on the September rate of increase and just points out how fast this credit has been growing, and for a very long time. We really are due for a slowdown. By comparison, consumers are only adding to personal credit at half that rate and only $12 billion borrowed. That's only 8% of housing indebtedness. Business is more bullish. They have borrowed $71 billion and that is still growing at 16% year on year. On the farm, debt has reached $35 billion and is growing at the same rate as housing. Easy credit may be over, but we're still hooked, and the momentum of it is propelling us further into debt, and at a rate far faster than economic growth. Our money supply growth continues to slow markedly, somewhat in contrast to the growth in credit. We track the broad measure of money, known as M3, and this growth slowed to 7.8%, way down from the recent high reached in December 2006. In fact, growth is now way less than half that. The actual money supply has been pretty stable now at $193 billion for over 6 months now, signalling a general slowing coming up in the economy. In fact, M1 and M2, which covers notes and coins and what is in everyone's bank accounts, has declined or been stable for most of that period. It was only our borrowed funders have been keeping the overall money supply growing. And that is a worry, of course, because it suggests that on average we're hooked on borrowing, and the fruits of that borrowing are not really ending up in more cash resources in the bank. The National Bank's respected measure of business confidence is now out for October, and it shows a modest ebbing in confidence. Generally, business is less optimistic, not only for the economy as a whole, but for their own prospects as well. The equity markets have taken on a rather sombre tone and retail momentum is waning. And of course there are clear signs the housing market is running out of puff. But prices for most commodities are still strong, infrastructure and other government spending continues apace, and there are real prospects for tax cuts. So it's not all negative. Far from it. The National Bank's economists are just suggesting our economy is in something of a sweet spot, and that we may be in the trough of a very mild slowdown. And if this is the low point, then this is a very soft landing indeed. But this survey shows that pricing intentions are still quite strong, so inflation is not dead yet. And those 90-day bank bill rates have hit almost 9%, indicating there are serious pressures building. Either we'll see an OCR hike next week, or the Reserve Bank will need to add some significant liquidity to our financial system. October might have produced sanguine confidence results, but December could bring different and difficult issues for us to deal with. And finally today, a wrap-up of some other items of interest. Capital and Merchant Finance was placed into receivership a few days ago. They managed to keep it quiet for a few days, which seems odd. This is an Auckland property financier who have about $200 million in monies borrowed by debentures. Not all of it was from retail investors, however. Fortress Capital of Sydney was a major funder, and it was they who called in the receivers when they found their loan arrangements had been breached. Capital and Merchant's financial structure was a bit unique because they were very highly geared indeed. 18 times debt to equity. Most finance companies are geared about 8 times, most banks about 12 times. High gearing is one indicator of susceptibility to stress. You get more news and start with Newsmaker Views on our news page. Join us again on Monday for the freshest finance news on the web. We'll see you then.